but I did want to just review a few things real quick. I had some questions previously about some of the charts I shared on what's happening in the industry right now, and I wanted to go ahead and share those. And then we'll talk to Jeff Stratton with North Point Mortgage about all the changes that are rapidly happening in the mortgage industry, and Christy Accurate with Luter, Larkin, and Hunter to talk about how some of the things you've heard in the news maybe haven't been thought out or panned out yet, and kind of what to expect in the closing process. So I'm going to go ahead and share my screen real quick. And take you to this great resource, which is Keeping Current Matters. And they have a paid subscription where you can sign on to it monthly. Can y'all see my screen?
Yes.
Okay.
Yes.
So you can pay for this monthly, but they've also created this section for the coronavirus specifically that you don't have to pay for. So this is mykcm.com/coronavirus is the website you can go to. And it basically gives you posts that you can use on a blog. It gives you some social posts, things like a recession does not equal a housing crisis, and a few quotes just to kind of things you can share with consumers to help keep them from being fearful of what they're doing when it comes to the home buying process. Charts and graphs, some videos on best practices, ways to calm fear in your market, and then it even gives you videos, so talking points when you're talking to your clients. So it helps you get a real idea of what these graphs actually mean. So for example, this is one I had shared on the Facebook group. The recession does not equal a housing crisis, where it walks you through what you can say to your consumers about this, which is a recession does not equal a housing crisis or crash like we saw in 2008. And the biggest point of this is typically where you see a recession causing an issue with home price changes is normally when the recession is caused by housing. So caused by lending guidelines or something like that. So 1991 was the savings and loans issue causing the recession. 2008, I'm sure we all remember, was from the housing crisis. So those are the times when you're really seeing a recession impact home values, but actually historically, home prices have appreciated. So in 2001, it appreciated 6.6%, and back in the early 80s, it appreciated during the oil crisis and things like that. Further down, they have some data on what they compare this crisis to be more similar to, which is 9/11 as opposed to what we saw in 2008. So they kind of see it as only a temporary scare, where you may see S&P going down, like for example, for the one for in 2001, it went down 45%, where housing continued to appreciate. The next slide is about what happened in 2008 versus what's happening right now, which is really interesting. Total home equity cashed out. So that means that if you look at this data in 2005, 2006, 2007, we cashed out $824 billion in our home values. Now the current amount cashed out is $232 billion. So it's a quarter of what it was in 2008 with the home with the housing crash. And what that means is, and here's the script for it, but what it basically says is that homeowners are less likely to even be incentivized or want to just give up their homes because they do have equity in them still. They're not, back in 2008 when values dropped, a lot of homeowners said, I owe $50,000 more than this home is worth. And so they were less incentivized to keep their home out of foreclosure. So that's what this graph is for. So I just wanted to share this resource. If you want to look through it, it's free for anyone, and it really kind of helps you with kind of how do you talk to the consumer about what's happening in the market. If you look at this one as well, this is kind of what they see happening with the GDP. So they're expecting, of course, it to drop and us to see the most significant drop as negative 24% in the second quarter. But we do see a sharp incline. So we're expecting towards the end of the year for the economy really to bounce back because of the programs the government has put into place, as well as the fact that this is illness related. It's not housing related. So some things I just wanted to share with you. And then let's get back to kind of what's going on in mortgages and in title. Christy, are you there? So can you just talk a little bit about your background and how long you've been in the field?
She's on mute.
Okay.
Hi there, we can hear you.
I've been working with title since 2002. So I have been doing this for a very long time. So I kind of feel like this market's a little bit familiar to me, and a couple different times that we've had a little bit of a disruption, not anything like this, but so we have a lot of practices and places that we can help things move along rather quickly. The industry kind of gathered together and had some stopgap things that we were able to do. So title insurance has been a big factor in being able to keep closings progressing through. So if anybody ever gives you any pushback about title insurance in the future, this is a good starting point to start with. So, but yeah, I've been doing it for 18 years.
So we're hearing a lot in the news about new regulations being passed where people can just sign online, and there's all these questions about that. If you can kind of give us an idea of what that means, and if that really means you can truly just sign online at home.
So no, so that we're not there yet. They have what's called RON, or the roving online notary. They're trying to create safeguards against fraud for that. Right now it is not a thing. You know, we still need notaries, we still need witnesses. So what Brian Kemp has released in terms of doing virtual closings is only halfway there. We still have some other things to work out. In the future it may be a possibility, but right now it's not anything we have in practice. We have some hybrid closings where people can close and sign closing documents ahead of time, but we still require wet signatures.
The attorney lingo, wet six. So, and then how does this affect you with title examinations and after closing being able to file?
Great question. So right now, title exams are taking a little bit longer to perform. We say about 7 to 10 business days because of closures. A lot of the counties aren't allowing title examiners in droves to come in. It's a very limited number. And some counties even aren't allowing anyone in there. Civil courts are closed right now. So if anyone has a divorce or bankruptcy, those documents are going to need to be provided when you're meeting with your clients to provide to the closing attorneys. So what we're doing right now is, instead of doing a 50-year search on most cases, we're able to ensure from when the title policy of the seller was taken out going forward. So we'll do an indemnity agreement and we will search from that date forward. So it kind of cuts down on some of the time in terms of just keeping things, the cogs, moving.
I think I'll just leave that up to you.
Yeah. I love it. I mean, everybody's like, whatever, but I love this stuff. And it's really fascinating to me that the industry came together and we have so many resolves and so many practices in place. It's across the board. Our preferred title companies all are on board with it. So it's not just like one's going to do it, one's not going to do it. We're all going to do indemnity agreements. We're going to work together as a team, keep this industry going, because we are an essential industry.
Yeah, we're all in it together.
That's right.
I think that is the positive thing, is it really forces you to kind of slow down, think things through, and figure out who your partners are that can help you and help the consumer.
Right. I'm really impressed. We have some language in our title policies about COVID-19 as well, and in gap languages, which might not mean anything to you, but it will make you feel good for your clients that we are insuring against any liability in the future. So they are secure with their title policies. It's not a watered down version. It's still an enhanced policy.
Awesome. Is there any other points with title that we need to hit on as far as what this has impacted or the changes?
I think so. So I think that we have to be really streamlined in our processes, and it might be something that we can parlay into our practices later, because I think it's going to create some efficiency on down the road. So when you are meeting with somebody, It may take a lot longer for us to get payoffs from the lenders because they're working on skeleton crews. So have them bring their, their mortgage letters with their account numbers. Submit those ahead of time. Don't wait for a seller's information sheet, kind of get ahead of it. Also, copy your driver's license before you attend closing. Put on the subject line that's your name, so you don't even have to have any kind of, communication with somebody across the desk. But also, it helps us verify that an individual is not who they are on title if they have a common name. So it'll help the title examiner, Bob Williams. If we have their ID already, we have a middle initial, we know that's not them, and we can just skip right over it. So it's going to streamline the process, but it's also going to make it more efficient. So a payoff that would normally take 24 hours for us to get, sometimes can take up to 6 days. So just get all that information together, submit it with divorces, estate information, anything you can get your hands on, just push it on through so we can keep y'all going.
Great, thank you. All right, and then let's give Jeff Stratton the mic with North Point Mortgage to kind of talk about, it really seems like let me see if I can change the view. It really seems like mortgages is where we're seeing the majority of the shift of what is acceptable, what's not, and this is really kind of impacting your industry. And I know you had a few points that you wanted to talk about. So can you kind of give us some details about what to expect as far as mortgage changes in the last couple weeks?
Yeah, basically right now, any mortgage changes you're seeing is companies trying to mitigate risk. So loans with higher credit risk, like the non-QM, no-doc loans, bank statement loans, have all been put on pause by those actual companies. So like Angel Oak, Deep Haven, Caliber, those kind of specialty products have been put on hold for the moment. That was the first changes we saw. We're now seeing changes tightening for FHA. For different companies have different overlays right now because they're higher credit risk because of this stimulus package that Congress put forth. Allowing people to go into forbearance for 6 months would be very damaging to lenders and servicers as a whole. So that's why they're raising the credit requirements to avoid people that possibly will lose their jobs or those with bad credit down to a 580 just not make the payment. Because that puts lenders and servicers in a bind that is a whole nother discussion.
So if they are unable to require the buyer to pay that mortgage that they just closed on for 6 months, that means that it's coming out of their pocket essentially.
Yes. Yes. The servicer, especially on government loans, right now on any loan, if the buyer does not make the first payment, that loan is now not sellable. So the mortgage company has to hold on a warehouse line, which just eats up their funds to fund loans. Hold on, let me take a look.
So that's FHA and VA, right?
Yeah, that's where I was going and getting at. With the government loans, the servicers, even if they don't make the first payment, the servicers have to make every payment for them. Mm-hmm. It's not insured and backed like Fannie and Freddie make the payments for the conventional loans. They have to make every single payment on the government loans, which was what makes it more riskier. So what they're trying to do is the Mortgage Bankers Association is trying to lobby with Congress to get HUD to step in and make those payments to take the weight off the servicers. Because if everybody goes into forbearance and they get laid off and they don't make those payments, especially on FHA, that will really hurt the servicing industry and lenders as a whole.
Well, I think, as scary as it is, I think our government is kind of fast acting on these kind of things and trying to ensure that our industries are not shut down. So, for example, Gwinnett County listed what is an essential business, and real estate firms are considered an essential business. Law firms and mortgage banking, I guess, is what that would be considered under.
Well, lending.
Yeah, specifically lending.
Go to banks.
Yeah. So for us, with realtors, we are saying as a firm, we are allowed, especially in Gwinnett County, to continue business, but we're not doing open houses. You can't have more than 10 people together at a time, and we are just trying to limit our contact with our clients and trying to work smarter, not you always say smarter, not harder, but smarter with less contact, I guess, is going to be the new phase. So what other things with mortgages does an agent need to know as far as what's happening in the market right now? What about rates, for example?
Okay. Rates went down to the lowest they've ever been at the beginning of March. And we saw a huge surge in refinance volume. This led to a very odd situation that we've never seen before. So with all the refinance volume, lenders getting backlogged with all of their process, they couldn't get stuff done, big banks, everybody. So with that happening, that caused a supply and demand problem with rates. Lenders had to artificially inflate their rates to slow down applications so that they could catch back up. For example, Wells Fargo yesterday announced that they will no longer be taking any more applications. They're just too busy. They can't get anything done. I had an agent call me yesterday, and they were on the listing side, and they've had a deal, the buyers with Wells Fargo, and it's been going on for 53 days. 2 days before closing, Wells Fargo said they needed 3 more weeks. So the refinance volume really affected that. So you're going to see a lot of the major banks no longer taking applications, or they're going to artificially hike their rates to mitigate new applications to kind of just price people out of the market. With rates right now, we've kind of caught up with the volume, but there's a whole other problem with these servicers, the bond market, the Fed pumping unlimited amount of money into the mortgage-backed securities to where it's a very complicated situation where they're dropping the rates. We're seeing it go down in the mornings, and then they'll come back up in the afternoon. So it's being artificially inflated to mitigate this volume.
So it's a test of all of our patience, right? With all these changes, and while we're waiting for them to figure it out. Denise asked, do these new guidelines apply to USDA loans too? What is the new minimum credit score for government-backed loans?
Yes, it applies to all government loans. Every company is different. The companies that are smartest and that are going to make it through this are the ones mitigating the higher credit risk. So people setting very temporary. Now, remember, this is temporary. This is not, like Tina said, this is not a housing crisis. This is a virus crisis. So when we get out of this, it's going to boom. Right now, we're at a 660 score when they lowered the max DTI to a 45 on all government loans. Now, like I said, every company is different. If they haven't changed yet, they will if they're smart and they want to make it through this. Because like I said about the FHAs not making payments, those lenders are going to be bogged down and they're going to completely lose their warehouse line, and their servicers aren't going to want to buy their loans. So they have to do this to survive through these next few weeks.
So the limitations that lenders, is the DTI regulated by the lenders
Overall,
too?
Yeah, overall credit. So high LTV, low down payment, credit scores, anything that makes the loan more riskier. So like 100% financing and bonds have all been put on hold. Anything higher credit risk to where they've just taken the guidelines and just kind of restricted it for now.
So the government guidelines have not changed. It's what the lenders are changing to survive, because if somebody doesn't make their payment, that's them having to make it on their behalf.
They cannot sell it. Then they cannot sell the loan if they don't make their first payment.
And then when you had said like Wells Fargo, for example, is not taking applications, is that for only refinances or for any like purchases as well?
That I'm not 100% sure. I just heard applications in general, and I'm hearing this across all the big banks because they had so much volume. The first 5 days of March, we had more applications in locks than we had all of August last year for our company.
Wow.
And you can imagine the big banks are more than that. So they got so bogged down, they have to catch up with themselves. So anything with them, you're looking at 60 days plus for closing. One of the other biggest hit is brokers. Mortgage brokers, since they have to shop lenders and send the loan to other lenders they're not going to close anything in 30 days. It's going to be the same as the big banks because they're second rate to who they send their loans to. And sometimes now they're even required to charge more points to even send their loan through because it takes so much work for that company to do it. So brokers have been very hurt by this.
So basically, lenders have a huge amount of demand and then also a huge amount of risk on the other side.
Yes, there's a
Without
very big
government protection.
Yes, there's not a lot of protection, and that's what they're working on with Congress is try to get the protection.
So if somebody is trying to get an application for a realtor, for example, if they have a purchase and sale agreement and they put North Point Mortgage U on there, what kind of is the parameters for timing to close? Because I would expect y'all would be seeing a delay too.
No, we are 100% dedicated to purchase business.
Okay.
We get contracts, we meet those contract dates. Right now, because of volume, we normally can close in 14 days, but right now our rush loans are 21 days and we're not having a problem with that at all. 30-day close, 25 days is not an issue with us because we're set up so strong. We're already set up where everybody can work remote. So we didn't have to adjust like the big banks running skeleton crews.
Mm-hmm.
We're very strong through this and we still close stuff when it needs to get closed. I have not seen any delays on any side.
What about for those concerned about losing their job, purchasing a home?
That's something that's very big right now. And that's something that a good lender is going to do, is going to talk to the borrower up front about their job stability. So for example, like people in the food service industry, probably not buying a house right now. Hairdressers, small self-employed businesses, it's just going to be tough for a while for them. So it's just using a trusted, reputable lender that has those conversations up front, not just rushing to say, oh yeah, I'll get it done. They have to ask the right questions to make sure you're going to get through and make sure you're going to actually close and being able to actually close it on time.
Okay, and then I had asked you this before privately, but I also want to just ask again for anybody that's listening. For these loans that are the minimum credit score is changing, the DTI is changing, is that for any loan in process now, or is it, how does that work?
No, that was just for us. Like I said, every company is different. And somebody will jump and say, yeah, we can still do that. We can still do that. But things are changing daily. Like these announcements just got rolled out late Sunday, some on Friday, some last Wednesday. So we are constantly being updated on these market changes. So it's really for loans starting today. If they were not locked before, we're going to honor the locks, of course, but this is everything moving forward for the next couple of weeks just to mitigate the risk and protect ourselves through this, because all the smart lenders that want to survive and come out strong, they're going to do this. If they haven't changed, they will change. And if they don't change, then it could get bad for them.
Yeah, I would think that the ones that don't change are the ones that are going to get taken advantage of with these lower credit score, higher DTI type opportunities. Is that all the points that we needed to touch as far as lending, or is there anything that we're missing?
No, one of the big things right now is sellers, and even on the refinances, people not wanting the appraiser to come in their house. Mm-hmm. So Fannie and Freddie have now allowed for external appraisals to be acceptable, to where they just do a drive-by appraisal, take photos of the exterior, they don't have to go in, and that helps with this fear of this virus for sellers. So there's ways around helping your sellers get their home appraised. There's ways for people to go in the house and see it and not touch anything, hand sanitizers and all that. They are loosening up requirements for VOEs to where we just need to get a verbal, get somebody on the phone or get an email from them saying, hey, they still work here. Not the necessarily formal of how we used to do stuff. So they are loosening changes to help guide us through this, which is good.
Yeah.
The other thing, it's very important right now if you're a listing agent to pay attention to who the pre-approval letter is coming from, what type of loan, and to call the lender and make sure they've seen all of the documents, they have reviewed everything, talked to the buyer about their employment stability, and making sure they can get it closed on time. Because like I said before, a lot of big banks and companies are running skeleton crews and they're not meeting closing dates. So at Fairway and North Point, we make the purchase a priority. So refinances still get done. We still take refinance applications, but they're locked for 60 days. So they just kind of, when we get to them, and they will close and they will get their rate and what they want. But purchase business will always be put as a priority.
Well, and I think you had mentioned too, like the refinances, a lot of the time, depending on equity, you're not even requiring an appraisal on those.
Yeah.
So there's-
Yeah, a lot of, and Fannie and Freddie actually started doing that a lot last year, completely waiving the appraisal requirement. If they have enough equity and stuff in it, they don't need to pay for one. It's just makes it easier. And we've done a lot of stuff on our back end to kind of ease the brunt of underwriting to make it smoother so that we can focus on these purchases.
Awesome. And then Denise just wanted some clarity. The higher credit score requirement, the change for that, is that for government-backed loans only?
Yes, that's just government. Because of, like I said, with the servicers having to make all payments for government loans right now, those are the higher risk.
So if you're getting a typical conventional loan, 3% down, 5, 10, those are conventional loans. Those are not impacted because they're insured.
Yes.
FHA,
All conventional
VA, USDA or specialty products are where you're going to see the shift and where you need to speak to your lender about
Yes, specialty products on hold completely.
Okay.
FHA, you definitely need to have a direct conversation with your lender about their changes and what's going on, because that's where it is. Just all government loans, conventional, we're fine.
Awesome. Well, I'm going to open it up. Does anybody have any additional questions or anything you want to discuss? Lori, Denise, anybody?
No, I think both Christy and Jeff covered a lot of the things that keep coming up that we see all of our people posting and sharing, and I think that you shed some really good light on all of those subjects.
So Lori and Christy, you were both in the industry in 2008.
Mm-hmm.
Jeff you have family that was in the industry in 2008. Kind of what?
Yeah.
I think this is kind of unprecedented times. We've never seen anything like this before. My first job was at Home Bank Mortgage out of college, so I got to experience the housing shift immediately when the bank closed down completely. And I think we've certainly seen banks learn from that. So that's probably a big reason why many of them are putting these limitations. And I think from the Keeping Current Matters information, you can see that a lot of homeowners have a lot more equity than they used to. So there's some comfort in that. So while we can't guarantee this is never not going to affect it and we're going to bounce back immediately, there's no knowing that. All you can do is educate yourself and focus on the people that know, like, and trust you, and saying, I have information, I can help you, let's talk through this, and be that professional source for them. So if there's not any other questions, we'll go ahead and end the call. But Christy and Jeff, I really appreciate y'all getting on the call. I know we all love video, right?
I'm actually loving this. This is great. Like, it's focused. I'm learning a lot from you guys.
Yeah. We've been using video a long time, but now I think it keeps you from being distracted from other technology, right. And it does keep you focused. It's funny, before this happened, me and Lori were talking about doing more webinars versus in-person class, because when you're running around, it's a little bit harder to get into the office with your hair done and everything, ready to go. So hopefully it is more convenient. But okay, well, I hope y'all have a good rest of the day. Thank you for keeping us updated, and I will post this into the group since Facebook is having a hard day as well. He doesn't want to live stream.
All right. Have a good
Okay.
one.
Thanks,
y'all.
y'all.
Thanks, Jeff.
Bye.
Bye.